Hey guys, welcome back. I'm the late fire starter, and today we're going to talk about the best ETF that beats the crap out of the market. You want to check this one out. It's a great dividend payer too. Yup. I'm talking about VYM. Let's look at it. This information and all that I'm going into is part of my journey, and I love that you're coming along with me on this. And so if you haven't yet, please subscribe to the channel. Just hit that subscribe button below. I would love that. You would make my day. If you could be so kind, go ahead and hit that like button as well. That would be wonderful. Did you know that Warren Buffett said if he could invest today, or he even said what he's going to do with his trust to pass on to the next generation is he's going to direct it to be 90% into an S&P 500 ETF. An ETF is an exchange-traded fund. What that means is just instead of a person managing all the trades and deciding what stocks come and go, an ETF pegs itself to an existing index. In this case, an S&P ETF would peg itself to the S&P 500. Every stock that the S&P 500 owns, this index would own. You can mess around with indexes, but the point of it is it's all automatic, and so it takes the human guesswork out of it. As a result, the fees on these things are really, really cheap. Rich people for many, many years have used what's called hedge funds to invest in. A hedge fund is a managed fund. What that means is you have the best of the best deciding what stocks, deciding what plays, deciding how to spend your money. They would take the rich people's money and they would make them more money. However, the fees on these hedge funds are extremely high. So much so that even those hedge funds that beat the stock market end up losing to an ETF when you take into account the expenses. In other words, if you put in $10,000 into a hedge fund, which you can't do because they need like $1 million to get into them. But anyways, you put in $10,000, that fund earns 10%. You just earned $1,000 profit on this investment. So the hedge fund, $10,000, a period of time goes by and you're up 10%, so you earned $1,000. That same ETF, let's say you put it in $10,000, and in that same period of time, let's say it only went up 8%. So instead of $1,000, you're up $800. However, in the hedge fund, what they're going to do is they're going to charge you more on the front end to manage it. They're going to charge you maybe 2%, whereas the ETF is going to charge you maybe 0.06%. So you see the big difference there. Now, here's the real kicker. The hedge fund on the back end is also going to charge 20% of what they got you. So if they made you $1,000, they're going to take $200 as a thank you gift to themselves. An ETF does not need thank. It is just an algorithm. After you earn the $800, you keep the $800. So yes, the hedge fund performed 10% returns compared to, say, the stock market's 8%. However, the 20% take-home fees as a thank you bring their earnings down to $800, which is exactly where the ETF was. When you look at this, you realize ETF expense ratios are what make them winners. Another fun fact, over 80% of all actively managed, meaning people are deciding how the money is spent, actively managed large cap funds, meaning dealing with large companies, have not beat the S&P 500. In other words, the S&P 500 has outperformed over 80% of actively managed funds. So you can pay a lot of money to have someone be a professional for you, or you can buy an ETF that follows the S&P 500. So you see the power in ETFs is really based on the fact that there's no emotion involved, there's no guesswork, you're looking at a whole lot of different factors, and there's diversification within the fund itself because each of these ETFs will have shares in multiple companies. Since I am trying to gain financial independence through rental income and through dividend income, my dividend portfolio has a core holding of a particular ETF that is 22% right now of my overall portfolio. I would like to see that raised up to about 30%. However, right now it is clearly heads and above my largest holding. This ETF also historically
has crushed
the stock market. This ETF has beat the S&P 500 ETFs. It has beat a lot of them. In fact, before I spoil the story too much, let's take a look at a 10-year, 15-year history. Let's take a look at a comparison. If you had invested $10,000 into VYM and you invested $10,000 into other indices, if you decided to take that $10,000 and put it just in another group of stocks, we will look at this and to see how does VYM fare compared to these other indexes. So here we are on good old Dividend channel. I'll put all the links on all this stuff below. And then what I'm going to do is hit calculator, and that's going to bring me to this page right here. So this is going to be drip returns calculator, which is basically dividend reinvestment program. So when you get dividends and you automatically reinvest them, it's going to show you how that affects the growing of your stocks there. And so we're going to go ahead and put in VYM since that's what we're starting with. It goes back 25 years, but what it'll do is it'll automatically adjust to the starting point of whichever one is closer. Okay, so let's compare it to the S&P 500 since that is the main ETF starting point. And that is basically what a lot of people mean when they say beating the stock market, is beating the S&P 500. And we're going to chart $10,000 invested. So that's going to bring us over to this page here. So as you can see, 1995, 8/18/1995 is when VYM started. The start price at that time was $11.12 for VYM and $56.17 for SPY. SPY is an ETF that follows the S&P 500 directly. So as you can see, the overall total return, this is incredible, for VYM in the last 25 years is 2,199.89%. That is with dividends reinvested. Okay, so this is dividends reinvested. At the same time, with dividends reinvested, the S&P 500 returned 888.82%. This ends up being an average annual return for the S&P of 9.49%, which I would take in a heartbeat. However, VYM has an annualized return of 13.21%, once again with dividends reinvested. And you can see here in the stock chart, this is VYM, and then this is the S&P 500 ETF. Both have done incredibly well, but look how much better VYM has done. This second chart you're going to see on all these is without dividends reinvested. So real quick, without dividends reinvested, the SPY ETF drops to 8.37% annualized, and the average annual return for VYM is 9.99%. I just want to point something out. Without dividends reinvested, the $10,000 put into VYM in 1995 would right now be worth $110,900. With dividends reinvested, that same $10,000 is worth $229,925. So you can see where the dividend reinvestment program, the DRIP program, has a huge benefit. Okay, let's compare VYM to a couple other things. Let's compare it to the Dow. How does it do against the Dow? Well, as you can see, we end up having a shorter time frame. Thus, instead of the over 200,000, the 220,000, the dividend reinvestment program ends up making 171,640 without 94,000. Once again, though, it does beat the Dow. This is a 8.23% average return per year versus a 13.22% with VYM. Once again, take out dividends, VYM still returned 10.3%, while the Dow returned only 6.94%. And I say only, but I would take a 7% return any day. All right, what about the NASDAQ? The NASDAQ has been a crazy growth index. We have seen the likes of Apple, Tesla just go crazy in this. I mean, crazy returns. So if we compare VYM, will it beat the NASDAQ 100 index? Let's check. Surprise, surprise, it also beats the NASDAQ. Now, if we focused in on perhaps the last year, it wouldn't because things have been crazy. But when you look at, here we are, QQQQ is the ETF that is pegged to the NASDAQ 100. That started in 1999. So now we're just looking at about 20 years. So once again, your overall investment in VYM is going to be lower because it's been growing for less time. When you look at the annualized average return, VYM is giving a 13.15% return, whereas QQQQ, which is the NASDAQ 100 ETF, is giving an annualized return of 8.99%. When you go down to without dividends, VYM drops to 10.36, and QQQQ drops to only 8.57 because in the tech world, dividends are not a factor. There are very few, and the ones that do pay are low paying. And that's why you see the difference here. So once again, here's the chart. If you'd started with the NASDAQ 100 ETF, you're pretty steady, and then all of a sudden you have explosive growth here. Whereas if you see with VYM, you have, well, this is crazy growth, but then you have the 2008 crash, and then boom, and then here's the COVID response. Whereas you see no COVID dip right down here, especially you see no COVID dip with the NASDAQ. That's why recently the NASDAQ would be beating VYM, but historically you see how VYM has really performed. Let's check now the total market Vanguard fund, VTSAX. This is the total market. So this is not following a single index. It is buying a piece of every stock that sells in the US stock market. How has VYM compared to VTSAX? Once again, quite well. As you can see, the average annual total return since 2000 is 14.8% against VTSAX 7.24%. So almost actually more than double return when you're reinvesting the dividends. Down here, also less than double, but close to double without reinvesting dividends. VYM is 12.27 versus VTSAX at 6.34. So you can see the power of dividend stocks, especially large cap dividend stocks that are held in VYM. They have historically outperformed all of these indexes. They've outperformed the S&P 500, outperformed Dow, outperformed the NASDAQ 100, outperformed the total stock market. So let's take a closer look at the Vanguard High Dividend Yield ETF VYM. This is the Vanguard website here. So the overview, it seeks to track the performance of the FTSE High Dividend Yield Index, which measures the investment return of common stocks of companies characterized by high dividend yields. It provides a convenient way to track the performance of stocks that are forecasted to have above average dividend yields, and it follows a passively managed full replication approach. That just means it's a computer doing it. The asset class is domestic stocks, large value. The expense ratio is 0.06%, so there are some cheaper ones. Some Vanguard funds are 0.03. There's some Fidelity funds that are zero altogether. 0.06% is a good bargain for this fund. You have today's market price is $88.93. The NAV is 88.92, so it's trading really close to its actual value. There's a premium discount of 1 cent, so it's not really a big deal. All right, so we go down here. This is what I really like. This is going to show you the portfolio composition, what's in this ETF, and I love this. The reason this is my core holding is because of all what you're looking at here. You're seeing the diversity. First thing I want to point out is there are 413 different stocks. So you buy one share of VYM and you're getting shares in 413 different companies. That right there is immediate diversity. That's what I love about this. Then when you look at the sectors, the US sectors, so here's different sectors of the US economy that dividend stocks look at. So here is the FTSE High Dividend Yield Index. So this is the index that VYM follows. And if you look at the FTSE index, here is the makeup. If you look at VYM, it's mostly the same, but a little different. For example, utilities is the same, 10.2. Telecommunications, 8.2, the same. Technology, the same. Industrials, the FTSE is a little higher, so 9.8 to 10.3. Healthcare, however, is the same, 14.10%. Financials is a little lower as well, 8.9 to 19. Now energy is a little higher, 5.2 to 5.1. Consumer staples is the same, 14.3. Consumer discretionary is the same, 6.4. And here's where you make up these lower differences is in basic materials, 4.3 to 3.8. All this is to say that the sector diversification is great. The stock holding diversification is great. Now let's look at the 10 largest holdings. 24.6% of all of VYM is in the 10 largest holdings. Johnson & Johnson number 1, Procter & Gamble, JP Morgan, Verizon, Pfizer, Walmart, AT&T, Comcast, Merck, and Intel. So you've heard of these. These are large cap funds. These are large known companies. These are huge companies. And these are really good solid companies that pay dividends. As you can see, it's a large cap value fund. Number of stocks is 413. The FTSE is 412. The difference is one of those is going to be cash. a cash holding. The fund total net assets is $33.9 billion. So it's not enormous, but it's not small. It's large. It's large for sure. Let's look at distributions real quick. This is kind of interesting. As you can see, one of the things I like about the ETF, especially during this COVID time, is that they take care of themselves. I don't have to sit there and sell and buy stocks myself and keep an eye on things real closely. Because if you look at a year ago, it's a quarterly dividend. They paid a little over 62 cents per share. Then it grew to 78. So the dividend stayed about the same for that quarter. Then you see this year in March, it dropped precipitously to 55 cents and change. 55 cents per share. That's a huge drop. What happened there? Well, COVID happened. Companies cut back their dividends or they cut them completely. But here's what I love about having an ETF that automatically adjusts. 3 months later, the next quarter, all of a sudden, the dividend went from 55 up to 83 cents and change. What happened? Well, some companies recovered and added their stocks, but an ETF will rebalance. And so when certain stocks go below a certain threshold, if they cut their dividend, they are removed from the index and another stock will replace it. The most recent dividend you see here is 70 cents and change per share, so it's dropped a little bit, but it's closer to these. So it'll be interesting to see how this turns out over time, but as you can see, it's a pretty solid dividend, and the stocks in this ETF are picked for dividend growth. So over time, the stocks in this ETF are increasing their dividend year over year. That's what qualifies them in part to be in this ETF. The dividend should be increasing over time as well. So that's VYM, Vanguard High Dividend Yield ETF. So as you can see, VYM is a great ETF. I am not a professional. I'm not a hedge fund manager. I am not an active manager. I am nothing legal here. This is just entertainment on YouTube. But if you're following my journey, you will see that my largest holding, my core base, my foundation to my entire dividend portfolio is VYM. I'm a big fan, and when you look at its performance over history, you see why. When you look at the fundamentals of it, you see why. And when you look at the diversity of it, you see why. Thanks for watching. Thanks for checking out VYM with me. Also, I have another YouTube channel. This channel is about how to make money in my journey to financial independence. I have another channel that's a little older, that's a little dormant, that I've revived, called The Cheap Guy. On that channel, I talk about how to save money. I would love for you to go check out The Cheap Guy, which is this guy, and see how to save money, find out other deals. I'm gonna put a link below and you can go check that out. Once again, if you haven't subscribed, please do. And if you haven't yet, hit the dang like button, would ya? Just hit it. Also, I love comments. I respond to all comments. If you like VYM, if you have VYM, let me know how it's been for you. If you have other ETFs that you think are better than VYM, or that you would like me to do a video on those ETFs as well, go ahead and comment below and I can do a video on those ETFs as well. Thanks so much for following along. I love having you here. I love that we're growing a community. Let's continue to share the love and enjoy this time together. Thanks so much. Have a wonderful day. I will see you on Saturday for my next real estate video.